Assalamualaikum and hi, my name is Nur Sakina and I'm from BA2724A. For this video, I'll be explaining on the answer for question 3 from past year question of January 2018. For question A, stated that sometimes future contracts are traded above or below the spot price. They asked to explain two situations and possible factors for such condition. The answer is, when future price is bigger than spot price, this occurs when storage or interest expenses are elevated or when trade anticipate that the asset's value will increase later on. Meanwhile, when future price is smaller than spot price, this happens when there is high current demand, restricted supply, or when the market anticipate the asset's price will decrease in the future. For question B, let's assume I am a fund manager managing a portfolio with 10 million. The current FBM KLCI index is at 1,800 points and I'm worried that the market might experience short-term volatility or even a downturn over the next 3 months. To protect the portfolio from potential losses, I decided to use a hedging strategy by selling index future contract, specifically the FKLI futures. First, we need to calculate the number of contracts. To fully hedge the portfolio, I need to calculate how many FKLI contracts to sell. The formula for the number of contracts is as shown, where portfolio value is 10 million, beta 1.2, future price 1,800 and contract size 50 ringgit per index point. Therefore, I need to sell 133 FKLI contracts. Now, let's imagine what happens over the next 3 months. These are the strategy. As expected, the FBM KLCI falls by 10%, dropping from 1,800 to 1,630.8 points. For cash market, I got losses which 1,128,000. Now, let's calculate the final net effect using this formula. So, instead of losing money overall, the portfolio is still around 10.8 million thanks to hedge. The effective index selling price for my portfolio after hedging is 1515.34. This means that even though the actual market dropped, I effectively locked in a better price due to hedge. In conclusion, this hedging strategy was successful. Without hedging, the portfolio value would have fallen significantly. With the hedge, I protected the value of the portfolio. This shows how futures contract can be a very useful risk management tool for a fund manager like me, especially during uncertain or volatile market conditions. Thank you.
Hi everyone, today I will walk you through a case of speculating in the FCPO or Futures Crude Palm Oil market for July 2017. Mr. Alex is an active investor in commodity futures. On 18 August 2017, he expects the price of crude palm oil to fall. So, he takes a short position by selling 5 future contracts at 2,734 per ringgit per ton. To open this position, he must pay an initial margin of 8,000 per contract. So, for 5 contracts, that's 40,000. He also needs to maintain a margin of 6,000 ringgit per contract, totaling 30,000 ringgit. Now, let's look at how the price moved over the next few days. On 19 August, the closing price dropped to 2730. Since he sold at 2734, he gains 5,000. On 20 August, the price dropped further to 2720, giving him an additional 1250 ringgit profit. However, on 21st August, the price rise to 2725 ringgit, so he incurs a loss of 625 ringgit. On 22 August, it rise again to 2732 ringgit, adding a further loss of 875 ringgit. Finally, on 23 August, it falls back to 2725 ringgit. If Mr. Alex closed his position on 23 August, the total floating profit is calculated as 2734 minus 2725 times 5 contract times 25 tons, and he will get 1125 ringgit. So over this speculation period, Mr. Alex makes a total profit of 1125 ringgit. This shows how future trading works on daily price changes and why it's important to manage margin and monitor movement closely. Now, let's look at what happened if the CPO price closed at 2738 ringgit on 23 August 2017. Remember, Mr. Alex opened a short position on 18 August by selling at 2734 ringgit, expecting the price to go down. However, the price went up to 2738 ringgit. Since the price moved against his short position, this resulted in a loss. We calculate this loss using the formula selling price minus closing price times number of contracts times contract size. Substitute, the value is 2734 minus 2738 times 5 times 25. So, Mr. Alex makes a total loss of 500 ringgit. This scenario shows the risk in speculation, especially in a downtrend. If the market moves in the opposite direction than the expected, the investor may suffer a loss. It also highlights the inverse relationship between price and return in a short selling. Here, a price increase causes a negative return.
Assalamualaikum and hi, I am Siti Maisara binti Mat Jarafi from class JBA 2724A. For this video, I will be explaining on the answer for question 4A from past question on February 2025. So the question is, Hassan, a trader, is bearish on the current 5-year MGS future market and aims to capitalize on the situation. The available quotation for the FMG5 on February 9, 2025 are as follows. For March, FMG5 contract 104.23 and for June, FMG5 contract 104.16. So the first question is, explain the type of spread trade Hassan will execute and outline the strategy he needs to execute to benefit from the current market condition. If the following information is available on March 6, 2025, assume he enters into 6 contract. March FMG 5 contract 103.68 and June FMG 5 contract 103.37. So here is the answer. Hassan is bearish on the 5-year MGS future, meaning he expects price to fall. To capitalize on this expectation, he should execute a best spread strategy using future contract. And let's moving on to the strategy of this. So we have March FMG5 and June FMG5. So for today, buy at 104.23 for 6 contract and then sell at 104.16 for 6 contract. And for later, sell at 103.68 for 6 contract and buy at 103.37 for 6 contract. Now moving on to the question number 2. Calculate the profit or loss Hassan would make based on the strategy outlined in the first question. So the answer is profit or loss, the formula will be selling price minus buying price times 100 basis point times number of contract times 10 ringgit. So we calculate profit for March FMG5 first. So 103.66 minus 104.23 times 100 times 6 times 10 ringgit and we got loss 3,420 ringgit. And then profit for June FMG5 104.16 minus 103.37 times 100 times 6 contract times 10 ringgit and we got profit 4,740 ringgit. And for the spread profit or loss, we take the loss 3,420 ringgit plus with 4,740 ringgit and we got profit 1,320 ringgit. And that's all. Thank you.
Assalamualaikum and hi everyone, I'm Sofia Zulika binti Senong from CBA 2724A. I will explain how to estimate profit from an intermarket spread based on past exam question from December 2013. Despite the slow recovery of the Eurozone countries, the stock markets in Asia have been performed reasonably well. A trader has the opinion that the Hong Kong stock market represented by the Hang Seng Index is expected to outperform the Malaysian stock market, represented by the FBM KLCI, in the next few months. The following data is available to the trader: September 2013 FKLI 1750, September 2013 Hang Seng Index Future HSIF 23,000, exchange rate HKD 100, MYR 40. The contract value for HSIF is the Hang Seng Index time HKD 50. The first question describes the strategy that the trader should consider if he will to take advantage of the situation. Is the intermarket spread. It's mean buying and selling into different markets in the same time to benefit from the price difference. In this case, we expect HSIF to perform better than FKLI. So we buy HSIF and sell FKL. Second question is calculate the number of contract involved in this transaction. Now, let's calculate the contract values. For FKLI, 1,750 times RM 50 equals RM 87,500. For Hang Seng in the future, 23,000 times HKD 50 equal 1,150,000 Hong Kong dollars. Convert that to ringgit by multiply by 40 over 100 and we get 46,000. For FKLI, the price dropped from 1,760 to 1,750, which is a loss. Multiplied by 5 contracts and RM50, we get a minus 2,500. For HSIF, the price went up by 1,000 points, giving a profit 50,000 Hong Kong dollars. Convert to ringgit, we get RM 20,000. So the final profit for this intermarket spread is RM 17,500.
For my part, I will explain about arbitrage question 1A July 2024. First, the question asks to determine whether they have an arbitrage by considering number of days. So it starts from 2 July. So we need to exclude the 2 days. So the way of calculate is 25th day of July plus 31st day of August plus 31st day of September. By adding the 3 months, we will get 90 days of TD. The dealer observed that crude palm oil CPO currently costs 4,200 per ton, but the September future is higher at 4,280 per ton. To earn a profit, he purchased 10,000 ton of CPO at 4,200 and sell future contract for September delivery at 4,280 ringgit. He kept the CPO until September, covering the storage and interest fees. In September, he delivered the CPO to settle the future contract and collect the increased future price. His profit is derived from the difference between the higher selling price and the overall cost of purchasing, storing, and financing the CPO. So that the strategy to outline the mispriced future contract for question 1A2. For the last question, we are being asked to calculate how much profit or loss a dealer makes using an FCPO trading strategy. The trader earned 42,800,000 ringgit by selling future contract at 4,280 ringgit per ton. At the same time, the dealer purchased 10,000 ton of crude palm oil on the cash market for 4,200 ringgit per ton, totaling 42 million ringgit. In addition, the merchant paid 522,602 ringgit 74 cents in interest and 695,342 ringgit 46 cents in storage charge for the oil. After deducting all of this expenditure from the future trading revenue, the dealer earned 415,810,19.80 ringgit. Simply put, the dealer earned by purchasing palm oil at a lower cost in the cash market and selling it at a higher price in the future market.